Good afternoon. My name is Rosslyn Butler with my podcast, Health, Life, and Insurance. And our topic today is Be Your Own Bank. Very exciting. People didn't even realize they could be their own bank. And through such a simple process as getting a life insurance policy, there's a special life insurance policy that you need to accomplish this goal. And it's called the IUL, Index Universal Life Policy. This particular policy is based on the S&P 500. You're not in the market, but you're having advantages as though you were in the market. One of the first things we begin to realize is that insurance policies, just like anything else, have IRS ties to them. So the IRS code 7702 is a private plan rather than one that's sponsored by your employer, such as the 401k. This one has what we call compound interest. You can borrow against it. You can take money from it and not have to even pay it back. It's with you throughout your lifetime. It's never settled out until your death. And you can purchase additional homes, put your children through college, as well as use it for your own personal retirement fund. So you'll find many uses for this particular policy, and it grows exponentially over the years, allowing you to use it tax-free and tax-deferred, which is very, very important. Let's start with the difference, say, between term and a whole life policy, which means that one is a short range that's set up for a number of years, the term policy, and it's going to end at a certain point. It's not to age 100, and even today you're getting up to 120. Some people are living well into their age 100 right now. Additionally, the whole life policy is very similar to the Index Universal Life in that it will travel with you throughout your life. You'll be paid dividends every year for the policy as long as it's paid on time and achieves its desired interest that it gets. It has all the benefits of the living benefits. I'm not sure that everybody is aware of what living benefits mean, so let me define that. Living benefits are 3 special benefits that you get with the current policies. Those of you that are still living with the old policies that don't have the 3 living benefits, this is a great question for your insurance person. Does my policy have living benefits? That's critical, chronic, and terminal. Critical means you develop some type of condition that you're going to have to deal with for the rest of your life. You're covered for that, and then it will give you the activities of daily life. If you lose any of those activities, you would be awarded a certain amount of money per month. It's almost like having Aflac or Colonial. Disability policies or income protection. The other one is for the lost my train of thought. Well, let's move forward with what the benefits are of the other term policies. Now, the universal life policy is the one that does not necessarily have the benefits, but today the newer ones do. So you definitely, even if you have a universal life policy, you want to get the policy that has the cash value build up, as well as the benefits for the critical, the chronic, and the terminal. Oh, that's where I was, forgive me. So the critical illness would be something like if you had a stroke, heart attack, some type of aneurysm. Chronic would mean something that's coming back again and again. You would get money for that particular policy. And then terminal gives you the benefits of recapturing some of your death benefit before you pass, which means you can pull down up to anywhere like 80 to 90% of the policy. Should you become terminally ill, if you're diagnosed with cancer or some disease that's going to be terminal, you would be able to take a trip, do what you like with some of the money, and the rest of it would go to your heirs. The way the policies are set up currently, you would not have that luxury of spending any of the money. All of the money would go to the person you selected as a beneficiary. So this is why a lot of people are moving away from that type of policy, because it doesn't have the benefits of you using it, whether you want to use it or not. It strictly goes to the beneficiary. Now that brings us to a critical conversation as well. When you think of physical fitness and you think of financial fitness, this is something that people are taking for granted. Once they get a policy, they never go back. They never call the insurance person out again to change anything, to update what's going on in your family. Some people die, some people are born. Sometimes people want to change the beneficiary. Maybe there's a new niece or someone that's been doing absolutely fantastic things for you, and you want to change some of the people you're planning on leaving money to. Maybe they've fallen off the wagon in some way, or they've changed their philosophy of life and you're not really in agreement with that. So if people change and they want to restructure these policies, you can always do that. So you need to be in constant contact, and we call it a physical fitness policy review. Not that you're changing anything, you're just reviewing what you have for the new year and seeing if you want to make any changes. That's perfectly fine, as well as looking at these policies to see if they're aging out so that you can change the policy, get a newer policy that offers you more benefits. The whole life policy is a permanent policy, which means that there is no time limit when your family can receive a benefit. Furthermore, some of the premiums you may go toward a cash account. Once the money inhabits that account, it will fund your eventual payout. However, you can also borrow against it or withdraw from the cash while you're still alive. And that's the benefit of both the whole life and the IUL, being able to pull money out in an emergency. So it's an emergency fund, it's a retirement fund, it's an education fund. Many people get the college fund, that 529 for their kids. Well, the problem with the 529 is that it's earmarked for a specific study. If the kid decides to go into engineering, or if they want to be a nurse, well, we know how people change their mind. If they don't go into that field, there could be some issues with the money being distributed for that particular purpose. So a lot of people are moving away from doing the college fund 529 and leaving it more broad and general so that the kid has the flexibility of changing their mind and maybe doing something differently, starting their own business. And it just leaves the doorway open for other paths of thinking. Universal life also is a permanent policy. It comes complete with cash value account. They're mainly differentiated by their flexibility, allowing you to adjust your premiums and death benefits. You also will be able to realize higher interest rates on the growth of the cash value, and you can use that cash value to pay your premiums. Your term life insurance, this type of insurance covers a specific time frame, which typically ranges from 10 to 30 years. So you get a 10-year policy, a 20-year policy, or a 30-year policy. The problem I have with the term insurance, particularly that one, you need to get the rider to be attached to it. So they have riders for return of premium, which means that all the money that you put in at the end of the policy, you're going to get it back. That's fantastic. Or you have a rider that you can convert it without having to go through the blood and urine testing part. Usually when it ends in 30 years, you're older. Could have been some changes to your health, And to try to qualify 30 years later for the same amount of money, 300, 500,000 may not happen for you because your health may not be up to par. So if you have this specific rider added to a term policy, it will cost you a little bit more. However, it's well worth it because we don't know, we don't have a crystal ball to look into the future to see whether or not you're going to get high blood pressure or diabetes or any of these other, not terminal illnesses, but chronic illnesses. And therefore could be a problem for you securing the same amount of money for your family to get should you pass away. Next, we like to talk to people about their financial goals and trying to help you set a financial goal. And one of the things we know is that everyone needs an emergency fund. And that's another plus about having a policy. Particularly the whole life and the universal life is very important to have money available so that you don't have to go into your savings. This is money especially earmarked for medical expenses, job loss, accidents, broken appliances, car repairs. Beyond that, we want to look at paying off debt. A lot of us have a tendency to overspend on these credit cards. So this also assists in that. And then saving for your retirement. Most companies are no longer allowing people to, well, they don't offer, not allowing them to, don't offer a pension. And where are you going to get paid in retirement other than Social Security, which they're saying in the coming years may not even be around. So each individual person now is charged with having their own personal retirement plan. Now, the retirement plans as we know them could be stocks. It could be buying a piece of property. Buying a home could be your idea of saving for your retirement. But more importantly, any plan that you start putting money into that you can set aside for 30 years that's going to double, triple in value can be considered a retirement plan. So we're looking at an IRA, which you can put $6,000 a year into. We're looking at this 403B for teachers, which they can put up to $17,000 in depending upon their age per year. We're looking at that 401k, which is oftentimes matched by the employer. The problem I'm having with the 401k is that if there's a slight downturn or correction in the economy and the interest rate drops drastically, you could lose up to 50% of your money in a 401k. So the safest, better bet is to put your money that you're saving for retirement into the IUL or whole life policy. There's a limit on how much money you can lose in an IUL, which makes that more superior product to purchase because your losses can't be more than 2%. You will always have a floor, let's say, of 2%. Also, another goal that you might have is to become a homeowner, which also gives you certain tax benefits, interest benefits against your taxes that you pay on earned income. Paying off and having a monthly car payment. Most cars now are running at least $400 to $500 a month. That's quite a big bite out of your salary, particularly if you don't make over $50,000 a year to be paying a $500 car note. So one of these type of policies could actually bring in enough money after a certain number of years for you to afford a car that you're paying that kind of money for. So we encourage people to use the whole life and the index universal life for those purposes. And I think for today we will stop there. And next time we will be talking about how we calculate how much money you need in a life insurance policy to sustain you and your family. Thank you.